This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this episode is Kyle Balkissoon, co-portfolio manager of the Hennessy Stance ESG ETF. Kyle, great to have you on Viewpoints by Hennessy.
Thanks. Thank you very much for having me here, and I look forward to our discussion.
Let's dig right in. Recently, you were on the On the Tape podcast on Bloomberg. In there, you use some terms that novices to the ESG space might not be familiar with. I want to talk about a couple of them. You used the term explainable ESG. What is that?
Well, explainable ESG is very simply, an ESG process that has very clear rationale as to why a company is good or bad. So at Stance, in conjunction with the Hennessy funds, we actually look at key data on a company and create processes to score them against their peers. So for every company that has a high score, we can say these are the rationales for them having a high score. And every company that has a low score, we can say this is why they have a low score. So one of the key things about that is these types of data sets reflect values that our clients have. So when we look at efficiency in, say, the industrial space, we're looking at which companies are more efficient with their energy, which companies are more efficient with their human capital, which companies are more efficient with their carbon usage. And we find that these things kind of move away from the debate of ESG is some kind of nebulous phenomena that, it's bad or this and that, and towards a very specific debate in that, do we think that companies that are more efficient with their use of environmental or human capital are more likely to reward their clients and have positive externalities for society?
In that interview, you also talked about your hard and fast exclusion rules. Could we dive into those a little bit? What are they?
Yeah, so our hard and fast rules are no weapons, no tobacco, and no direct fossil fuels. We do understand that the world is run on fossil fuels, so we tend to exclude fossil fuel producers. We do have a bit of an out though for companies that have made a 50% commitment to renewables, as demonstrated by their capital expenditures. So if a large fossil fuel or oil company is saying, I want to stop doing this and I'm going to spend 50% of my capex on renewables, we will include them in. But until that gets hit, which it has not, they're out.
All right, so 50%, that's a big number. Are there any companies top of mind that fit that criteria that might surprise viewers?
There's not a single one that passes that at the moment. But we wanted to put it in there to try to move or incentivize, despite our small size, incentivize fossil fuel companies to invest in other areas. If you think about them, they're really businesses that are about powering the way we do things, whether that comes from rocks or gunk out of the ground, or comes from the sun, or comes from wind that turns a turbine, or water that turns a turbine, or something. It doesn't really matter. So for them to kind of shift their businesses towards things that are more renewable, and I'd argue better for the planet, it doesn't have to be perfect, but just better, would be a very large movement. They're also some of the largest companies in the world in terms of revenue and capital expenditures.
Let's shift gears and talk about your thoughts on the markets here for the rest of the year. We're recording this in August of 2023. How do you see things playing out?
I think it's been a pretty interesting year in that a lot of the stuff that got hammered last year has gone up. So mega cap tech has outperformed. Despite we're not really seeing a lot of big growth, it just kind of rebounded. So I'd say if you think about the market environment that just happened, we've had a pretty strong rally that's been highly concentrated in mega cap tech. Despite the fact we've seen mild and small growth in terms of top line, there's been some earnings compression. I'm talking about more broader in the S&P. We expect to see, in terms of returns, we expect to see returns coming from outside of mega cap tech, because we do think that story is kind of done now. It went down. It was a value play. I mean, Facebook was a value play at the start of this year, arguably. Some investors jumped on that, and now it's kind of normalized. We actually see a lot more value in the industrial space, in healthcare, what I would call more thematically broad segments of the economy. And also, what makes healthcare very interesting is that healthcare has demographics on their side in terms of an aging population, a lot of people needing more things. So we expect the demand for a lot of the products and services in that segment to go up massively. And industrials, I call it physical AI and automation, meaning we've seen a lot of AI improvement in the last, I'd say, 5 years on the software side. And we're starting to see a lot of the automation on the robotics side, on the warehousing, on the manufacturing processes. And I think that story has a lot more to play in the industrials area. So I'm personally thinking that productivity and margins are going to increase in industrials as companies get more and more automated and are able to kind of squeeze more out of each individual worker. The other thing is the current labor situation that is very tight in manufacturing and in industrials is forcing companies to make those investments whether they like it or not, despite the higher interest rates.
Well, so here's a softball for you, for anybody who knows your work, and it really tags along with what you were just talking about. What is your take on AI in the workplace today?
I think there's a lot of buzz going on, and we're going to start to see more and more of it, but in ways that I don't think they're going to just knock out a lot of jobs. What I do think is going to happen is they're going to make existing employees more efficient, and they're not going to hire as much. So I'll give some real examples. In the customer service space, you're starting to see a lot of things dealt with chatbots who are pretty clunky. Where before they might have had a form, now they have a bot, and in some cases, pretty good. I mean, I'd say in hospitality, in hotels, they've got them pretty good where they can handle check-in, check-out, requests, this and that in a very streamlined user interface. We're seeing it for in the consumer segment around returns, customer service. So we are seeing a lot of it there in the what I would call more if you go up the value chain in terms of research or people having to look into things. It's a solution that's as good as probably a bad intern. When you ask an LLM a question, you're going to get an answer, but it's not always right. And even if it's 50 to 60% right, it might have saved you some time. And I do really view it as a time saver versus a replacement because the errors are still too big. You can't get rid of a person with a 50% solution, but you can make them more efficient saying, hey, I've got you a pretty dumb intern in chat GPT-4. So it's something that's a bit different in our industry specifically. I expect to receive hyper tailored emails now from people who want our business in different forms. In the sense that they can have these tools read our websites, read our bios, find out key things, and kind of write a crafted email that kind of speaks to the interests or things that we might be looking for. So I do see some automation there on its way, and actually we've been on the receiving end of those. So I do expect more of that. I do think the biggest part of AI is going to be on the what I call in the manufacturing and hospitality spaces where computer vision, as it improves, will start doing processes that people done manually, like grab thing, put thing there, move this from there to there. And you're going to start seeing a lot of those things come out, whether is that AI or robotics, is both, but I really do think that's going to come out more and more. We've been seeing it in fast food, we've been seeing it in hospitality, we've been seeing manufacturing, and if they can't find the workers, they're going to find a machine. And as the cost of those machines go down, probably 6 years ago, the guys doing the burger bots all in one wanted, I think it was like $20,000 a month, and it did the work of 3 employees. Now it's 3,600 a month. So the cost is coming down and adoption is going up.
Let's pivot and talk about your fund.
Yep.
Earlier this year, we had a chance to go deep on the Hennessy Stance ESG ETF with your partner, Bill Davis. Let's talk about some of the individual holdings and specifically what is the investment and ESG case for these holdings. Let's start
Sure.
with Microsoft.
So Microsoft is an interesting one in that I'll start off actually with the fundamental case and then I'll move to the ESG space. Microsoft is generally a pretty good ESG performer. They're above average on a lot of their KPIs. They're not the best at anything, but they're just better. What we're actually more interested about Microsoft is we're seeing top line growth, uh, and we're forecasting top line growth too, which is actually very interesting for us in that Microsoft is massive. If you think about it, Microsoft powers a lot of the economy. Their tools are everywhere, and we're just seeing growth in cloud. We're seeing growth in tooling. We're seeing growth in software. The whole office in the cloud thing is going to be very interesting as it'll solve my PowerPoint on Mac doesn't work the same as it does on PC, or my Excel on Mac doesn't work the same. And it also it makes them device agnostic. Given the migration of laptops to ARM from x86, I do think Microsoft's pivot to cloud is going to be very powerful, and not only from an ESG standpoint, being hardware agnostic, because meaning that we don't need as much hardware going around, but also from just from a plain old business standpoint.
So, what's the investment case for United Health Services?
United Health Services is very interesting in that it's not that special of a company from an ESG standpoint. They're above average. They do things well. We expect to see earnings growth largely driven by demand. We're seeing some margin expansion as they make investments into both automation and AI and other forms of cost reduction. So they've actually started to get lean, which is, and then if you think about demand for healthcare, it just keeps on going up and up and up. So leaner cost structure, more sales. So I'd say we are pretty bullish on them from a margin standpoint, and we hope that translates into returns, obviously.
What's the investment case for Visa?
Visa's a funny one in that Visa makes their money primarily through interchange. So it's pretty much a tax on, I hate to use the term tax, but they're pretty much a tax on on retail transactions or card swipes. Visa is, we do expect the economy to still grow. Start of this year, I was forecasting a positive GDP print for the year. And next year, consumer spending, despite the fact it's slowing down, is still pretty strong. So we do expect Visa to continue to profit off of that. And we do think that Visa overall is a strong, high margin firm.
What's the investment case for Snap On?
Snap-on's a different beast. I mean, they are, I'll talk a bit about them, but they're kind of neither here nor there in the sense that they do manufacture tools, they do sell tools. They've been onshoring a bit more of their tool production, which has allowed them to access some pockets of demand. Their execution on that has been mixed. The algorithms like them most because we see them growing one top line. We see them growing top line with not a lot of additional capex or even just plain old expenditure. So we do expect Snap-on to grow.
Let's wrap up with this question. Given the backlash around ESG over the last 12 months, what do you personally want investors to know about ESG investing?
I'd first and foremost say that it's not all the same. The ESG label is a bit very broad. It's like saying value. I'll make an analogy to value. Are you a value from a cash flow standpoint? Are you value from a book value? Are you value from an asset standpoint? The same thing with ESG. Do you care about carbon? Do you care about society? Do you care about workplace rights? Do you care about what initiatives these companies are doing in their community? So you really have to get specific and say, what are the key themes or areas that this fund is that is lining itself up with, and how are they using those values that they've stated? So whether it's carbon, energy, whatever, and how are they using those values or evaluating them with respect to potential investments? That would be it. I really think the backlash is kind of fake. I think it's manufactured fakeness in the sense that people are just trying to shoot at something that does not exist. And the more we make it real, the more we make it concrete, the more we can have an informed discussion as to how these values actually map out in the investment space.
Excellent. Kyle, thank you so much for your time, and thanks for coming on Viewpoints by Hennessy.
Thank you very much for having me here. Bye.